Ladies and gentlemen, something unusual is happening beneath the surface of the global financial system. Something quiet, calculated, and deeply significant. The yield on the US 10-year Treasury yield has surged to 4.28%, sending shockwaves through markets worldwide. For most people, this number might seem technical, but for governments, central banks, and global investors, it is a warning signal, one that is triggering a silent but powerful shift. Three major nations, China, Japan, and Saudi Arabia, are quietly reducing their holdings of U.S. debt. Not with headlines, not with announcements, but with steady, deliberate action. Why does this matter? Because for decades, the global financial system has been built on trust in U.S. Treasuries. These bonds were considered the safest asset on Earth. But today, rising yields mean falling bond prices, and that means losses for those holding them. This is not just about interest rates, it's about confidence, it's about strategy, and most importantly, it's about a changing world order where nations are rethinking their dependence on the United States. As borrowing costs rise, as inflation pressures persist, and as geopolitical tensions grow, these nations are not panicking. They are repositioning, quietly, strategically, and with long-term consequences. The question is no longer whether change is happening. The question is, how far will it go? The move to 4.28% in the US 10-year Treasury yield is not just another fluctuation. It represents a sharp repricing of risk across the entire global financial system. To understand why this matters so deeply, you have to look at the mechanics of how bonds actually work. When interest rates rise, newly issued bonds offer higher returns, making older bonds with lower yields less attractive. As a result, the market value of those older bonds drops, sometimes significantly. Now consider the scale. Countries like China and Japan are among the largest holders of U.S. Treasuries in the world. These are not small, speculative positions. They are massive reserves, often built over decades, held as part of national financial strategy. When yields rise rapidly like we are seeing now, the paper losses on these holdings can reach into the tens or even hundreds of billions of dollars. Even if these losses are unrealized on paper, they still matter. Central banks and governments operate on balance sheets, and the value of their reserves directly impacts their financial flexibility, currency stability, and policy decisions. A sudden drop in bond values weakens those balance sheets, forcing policymakers to make difficult choices. Do they hold and hope yields stabilize? Or do they start selling to prevent further losses? This is where the quiet shift begins. Instead of making dramatic moves that could shock markets, these nations often reduce exposure gradually, selling portions of their holdings over time. But even gradual selling has consequences. When large holders begin to offload treasuries, it increases supply in the market. More supply with less demand pushes bond prices even lower, which in turn pushes yields even higher. That creates a self-reinforcing cycle. Rising yields cause losses. Losses trigger selling. Selling pushes yields even higher, which leads to more losses. It's not a sudden collapse. It's a slow pressure build, like a tightening spring in the financial system. For Japan, there's an added layer of complexity. As U.S. yields rise, they begin to compete with Japanese government bonds. If domestic yields in Japan increase even slightly, investors may prefer to bring money back home, especially when currency risks are considered. This creates additional incentive for Japanese institutions to reduce U.S. bond exposure. Meanwhile, China faces a different challenge. Managing a large stockpile of U.S. debt while navigating economic slowdowns and currency pressures makes holding depreciating assets even less attractive. Reducing Treasury holdings becomes not just a financial decision, but a strategic one tied to long-term economic planning. The key point here is that rising yields don't just affect traders or investors, they directly impact sovereign decision-making at the highest level. What looks like a simple percentage on a screen is actually triggering a chain reaction across central banks, currencies, and global capital flows. And because these moves are happening quietly, without official announcements or dramatic headlines, they are often underestimated. But beneath the surface, the impact is cumulative. Every incremental rise in yield, every small reduction in holdings, adds to a larger shift that is gradually reshaping the global bond market. For decades, the global financial system has revolved around one central pillar: the dominance of US dollar assets, particularly US Treasuries. These instruments were not just investments, they were the foundation of national reserves, trade settlements, and financial security for countries around the world. Holding US debt meant stability, liquidity, and trust in the world's largest economy. But that long-standing strategy is now being quietly reevaluated. Nations like China are no longer comfortable placing such a large portion of their reserves in a single asset class tied to one country. Instead, they are actively diversifying. This includes increasing gold reserves, expanding holdings in non-dollar currencies, and investing in real assets such as infrastructure and energy projects across multiple regions. Gold in particular has regained importance because it is not tied to any one government or monetary policy. It acts as a hedge against both inflation and geopolitical uncertainty. At the same time, Saudi Arabia is undergoing a broader economic transformation. As part of its long-term vision to reduce dependence on oil revenues, the kingdom is also rethinking how it allocates its financial reserves. Rather than relying heavily on US Treasuries, it is channeling capital into sovereign wealth funds, global equities, technology sectors, and strategic partnerships across Asia and Europe. This shift reflects a desire for higher returns, but also greater control and flexibility in a rapidly changing global environment. Even Japan, traditionally one of the most loyal and consistent buyers of US debt, is beginning to adjust its approach. Japanese institutions, including pension funds and insurers, are increasingly sensitive to currency fluctuations and hedging costs. When the US dollar becomes volatile or expensive to hedge, the attractiveness of US bonds declines. As a result, Japanese investors are exploring alternatives, including domestic bonds and other international markets that may offer better risk-adjusted returns. What makes this shift so significant is that it is not happening suddenly or dramatically. There are no public declarations, no abrupt exits. Instead, it is a slow and deliberate process, small reallocations over time that gradually reduce dependence on US assets. This kind of movement is harder to detect in the short term, but far more powerful in the long run. Another key factor driving this diversification is risk management. Relying too heavily on a single country's financial system exposes nations to policy changes they cannot control. Interest rate hikes, inflation shocks, sanctions, or political instability can all impact the value of US assets. By spreading their reserves across multiple asset classes and regions, countries are effectively insulating themselves from these risks. There is also a broader structural shift taking place in the global economy. Trade relationships are evolving, new economic alliances are forming, and emerging markets are gaining influence. In this environment, holding reserves in a more diversified portfolio aligns better with the multipolar world that is beginning to take shape. Importantly, this does not mean the end of US Treasuries or the collapse of the dollar's role. Instead, it signals a gradual rebalancing. The US is moving from being the overwhelmingly dominant reserve asset provider to being one of several key options in a more diversified global system. And that distinction matters, because even a small percentage shift in the portfolios of major economies like China, Japan, and Saudi Arabia can translate into hundreds of billions of dollars moving out of US debt over time. This is how financial power shifts in the modern world, not through sudden collapse, but through quiet, strategic decisions that slowly reshape the balance of influence. In today's world, finance and geopolitics are no longer separate arenas. They are deeply interconnected, influencing each other in ways that are both subtle and profound. The decision by nations to reduce exposure to US debt is not purely economic. It is increasingly shaped by political strategy, national security concerns, and shifting global alliances. Take China as a primary example. Its relationship with the United States has grown more complex and competitive over the past decade, spanning trade disputes, technology restrictions, and regional influence. In such an environment, holding vast amounts of US Treasuries creates a form of financial interdependence that can also be perceived as vulnerability. If tensions escalate, Financial assets tied to another country's system could become leverage points. By gradually reducing its holdings, China is not just adjusting a portfolio, it is recalibrating its exposure to geopolitical risk. For Saudi Arabia, the calculation is different but equally strategic. As the kingdom strengthens ties with emerging powers and diversifies its global partnerships, it is also rethinking its long-standing alignment with US-centric financial structures. Energy trade, once almost exclusively dollar-based, is beginning to see experimentation with alternative currencies and bilateral agreements. This evolution reflects a broader ambition to operate with greater autonomy on the global stage. Reducing reliance on U.S. debt fits naturally into that objective, giving Saudi Arabia more flexibility in navigating a multipolar world. Meanwhile, Japan faces a delicate balancing act. As a close ally of the United States, its financial and security interests are closely linked. However, Japan must also respond to regional pressures, economic realities, and domestic policy goals. Rising global uncertainty, combined with shifting dynamics in Asia, means that even close allies cannot afford to ignore concentration risk. Adjusting treasury holdings becomes a way to maintain stability while still preserving strategic relationships. Another critical factor is the increasing use of financial systems as tools of policy and influence. Sanctions, restrictions on financial flows, and control over global payment systems have demonstrated how economic instruments can be deployed in times of conflict. For countries observing these developments, the lesson is clear. Excessive dependence on any one financial system can carry long-term risks. Diversifying away from U.S. debt is, in part, a response to this evolving reality, a way to reduce exposure to decisions made hard to their own control. There is also a psychological dimension to consider. Confidence is the backbone of any financial system, and geopolitical tensions can erode that confidence over time. Even the perception of instability or conflict can influence how nations allocate their reserves. When trust becomes less certain, diversification becomes not just a strategy, but a necessity. Importantly, these shifts are not coordinated in an obvious or public way. There are no joint announcements or synchronized moves. Each country acts according to its own interests, timing, and priorities. Yet the outcome is remarkably aligned: a gradual reduction in reliance on US Treasuries and a broader redistribution of financial assets across the global landscape. This creates a quiet but powerful transformation. Instead of a single dominant financial center, the world begins to move toward a more distributed system, one where influence is shared and no single nation holds the same level of control it once did. And at the heart of this transformation is the recognition that, in an era of rising geopolitical tension, financial decisions are no longer just about returns. They are about resilience, sovereignty, and strategic independence. As yields climb toward and beyond 4.28% on the U.S. 10-year Treasury yield, the implications for the United States extend far beyond financial markets. They strike at the core of how the government funds itself. At its simplest level, a higher yield means the U.S. government must pay more interest to borrow money. But when you scale that across trillions of dollars in national debt, even small increases in rates translate into massive additional costs. The United States relies heavily on issuing treasury bonds to finance its budget deficits. These deficits are not temporary, they are structural, meaning the government consistently spends more than it collects in revenue. To bridge that gap, it must continuously attract buyers for its debt. For decades, strong demand from foreign governments like China, Japan, and Saudi Arabia helped keep borrowing costs relatively low. But as these major holders begin to reduce or slow their purchases, the dynamics shift. With less external demand, the U.S. must offer higher yields to attract new buyers. This is essentially the market forcing the government to pay more to access capital. It's not a policy choice, it's a requirement imposed by supply and demand. Over time, this creates a compounding effect. As older, lower-interest debt matures, it must be refinanced at current, higher rates. This means the overall interest burden on the national debt steadily increases. What was once manageable at lower rates can quickly escalate into one of the largest components of government spending. And here's where it becomes more complex.